Welcome to my channel. I'm the cover call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields $70,000, just a little over $6,000 a month, or about $6,000 a month. I'm open-minded to whatever investments that you think I should be leaning towards to as I reach my goal. I should reach my goal by ending year 2026 or mid or early 2027. So guys, I'm open-minded. Let me know, leave a comment, and I am absolutely open to new ideas. Legal disclaimer before we start: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Please always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, today's video is going to be on a very popular, up-and-coming, rising ETF fund. It is absolutely one of my favorites, and I used to own two ETFs here, but I just consolidated into one, and I will let you guys know what it is by the end of the video. Or if you follow my channel, you already know what it is. Anyways, let's get started on Amplify. The Amplify fund. I absolutely love this fund. I believe that the managers do a great job, and they have a great track record with DIVO. This is going to be an in-depth analysis of the Amplify EOSmart suite, a comprehensive DD report for income investors by me, the covered call guy. All right, funds discussed in this report is DIVO, DIVO, IDVO, QDVO, HCAL, TLTP, SLJY, BAGGY, EHY, BIDDY, ETTY, and SOLM. Okay, let's begin. There's going to be 7 parts to this, right? Part 1 is the ecosystem. Again, as you know, if you guys been following, I care a lot about the ecosystem of the fund, because how the managers execute, how they perform outside of the fund, and what their strategy is, how they communicate, right? It means a lot to me. And then part 2 is the core CWP, which will be explained. They pretty much the managers of certain funds and the ETF. Part 3 is thematic suit. Part 4 is performance. Part 5 is the ROC Trap. Part 6 is my verdict, and part 7 is just the sources used to create my slides. Okay, part 1, an in-depth analysis of the Amplified EOSmart suite. All right, part 1, the Amplified EOSmart ecosystem. All right, we got to understand Amplify's suite, Amplify's ideology, right? They required to understand 2 distinct philosophies: a total return approach focused on balancing income with growth, and a max income approach focused on maximizing distribution, often by sacrificing all the upside. All right, so let's read through the 2 core philosophies. Philosophy 1 is the total return, tactical total return. Their goal is to balance income with capital appreciation. Their method: active stock selection of 20 to 50 stocks. Strategy: partial and tactical call writing. The coverage of the portfolio: 20 to 60% are written with calls, leaving the rest open to either grow or capture upside. Upside: retain significant upside participation. And the funds that do this is DIVO, IDVO, and QDVO. Then they have philosophy 2. Philosophy 2 is a systematic max income, right? They use thematic and crypto suits. Their goal is to maximize current distribution. Their method is systematic rule-based overlay. Their strategy: full or partial systematic call writing. Their coverage: it varies from 30 to 100%, and that leaves the upside to be intentionally sacrificed, most or all. And the funds that use this philosophy is HCAL, TLTP, SLJY, BAGGY, EHY, BITY, ETTY, SOLM. And here is just their roster, right? So I won't go through it. I just said it, and guys can pause the video, take a look at it. This is just their, like I mentioned, the top 3 is for income and growth, and then the rest is for maximize income. All right, part 2, the core CWP suit, DIVO, IDVO, and QDVO. This suit is actively managed by Capital Wealth Planning, right? So Capital Wealth Planning, they're just a they are a registered investment advisory firm, so they pretty much help amplify. This is what you should do. This is what stocks. This is the strategy you should execute. So their philosophy is to balance income or growth through active stock selection and unique partial coverage, call strategy. So here we have to get into the universe, right? You have to select a fund universe, right? So this is kind of how they think CWP thinks, right? So step 1, let's pick which index universe we want to pick: SP 500 or the MSCI or the Russell 1000. Then once we pick one, right, we have to do they do the screening. They screen for high quality dividend and earning growth stocks and within that universe. And then 3 is the pretty much the qualitative, right? Qualitative. They filter for strong management, cash flow, and high returns. And then the following portfolio, right? After that, they filter out some more, and then it comes down to a 20 to 50 stock portfolio. So again, the big downside is that these 3 funds will be concentrated, right? So right here, this is the beautiful part of the CWP strategy. By only covering a portion of the portfolio, the rest is free to participate in market rallies, right? So look, DIVO, covered upside 25%, uncovered 75%. IDVO, covered, which is upside capped, 45%, leaving upside potential at 55%. And QDVO is 40% upside capped, leaving about 60% upside potential. Beautiful. And this is just the DIVO is US large cap. So look at the sectors: financial, information tech is 17%, financial is about 30%, industrial is about 17%, consumer discretionary about 16%, and others is 22%. And then IDVO is international, other 27%, financial is 21%, consumer 17%, communication service 12%, and then they do Canada almost 13%, Japan almost 11%. And then QDVO is US growth, other 28%. Infotech was super heavy, concentrated in information technology is 41%. Communication service about 21%. And then NVIDIA is 11%. So if NVIDIA breaks, it will completely destroy QDVO. So they are betting that NVIDIA is going to hold up in almost all types of economic solutions, because if NVIDIA cracks, then you say goodbye to QDVO. Part 3, thematic and systematic high income suit, right? This group abandons the CWP total return philosophy. These are rule-based products designed to maximize distributions. This introduces different, in some cases, uglier risk. So these stocks that are going to be mentioned, right, they are not handled by CWP. CWP does only the top 3 that were mentioned. All right, this is just a rule-based, so they don't need any outside influence. It's going to be strictly amplified, and basically they're going to be their strategy is it's across the board. Hey, this is strictly how it's done. This is how we're going to do it. We don't need anybody to advise us. All right, so the ugly risk, right? HCAL marketing versus reality. A critical finding that I found is the discrepancy between HCAL's marketing and its legal perspectives. This is a failure of transparency. That was a big red flag for me. I didn't like that. What marketing implies for HCal was that it does tactical calls on individual stocks, similar strategy to DIVO, targets plus income. But what I found when what I was reading is that the perspective says systematic route-based strategy, sells calls on SP 500, uses swap agreements, and introduce counterparty risk, right? So if they're willing to try to hide and be sneaky with that, that wasn't really for me. I didn't like that. So then it questions all of the thematic ETFs. So TLTP and SLJY, right? They target high income and they generate these yields by writing calls on highly volatile assets, right? The high premium is compensation for high underlying risk. TLTP is 12% target and they do the 20 plus year treasury, versus SLJY 18% target and they do the silver miners, which is a speculative asset class because it's not the actual silver. Right, and then we have the ugly risk for synthetic crypto ETFs. You know, I'm not a big fan of anything synthetic. If you can do crypto, I'd rather have just almost at least indirectly holding the crypto. So the crypto funds Baggy, EHY, and SOLM, which is Solana, do not hold crypto directly, right? They're derivatives of derivatives, which introduce layered risk. As you can see the risk here, right? It's just a clone of a clone of a clone. Why would I want that, right? I want the real thing as close as possible. And then the crypto strategy, max income versus targeted income. The new targeted income funds like Solana, Biddy, ETTY, or a beautiful innovation, unlike max income funds like Baggy that caps all upside. These new suits use partial coverage like DIVO to allow for significant upside participation, but I still question it a little bit, right? So you see here uncover upside potential. Solana targets for 55%, and then Solana has the upside capped at 45, and then capped upside is 100% for Baggy. You see, no good. Yuck. All right, part 4, performance and risk, the good, ugly, and bad, right? We have a chart here, performance analysis reviews, the fundamental trade-offs, the beautiful downside protection in bear market comes out of ugly or bad cost of underperforming in strong bull markets, as expected of cover call ETFs. If you're new, welcome. Cover call ETFs will always have this trade-off. Some might do better than other, but the trade-off is always going to be that growth will always outpace cover call ETFs, as you are not here for the growth capital appreciation. You are here for the income. Now, yes, QDVO does emphasize growth first and income second, but it's still like a 60-40 mix. The beautiful DIVO versus JEPI versus SP 500. As you can see, DIVO's 2022 performance is proof of concept, massively outperforming in a down market, but this comes at an ugly cost of underperformance in bull years like 2023, right? I bought S&P up 27%, JEPI 10, and DIVO not so much, and only down in the bear market, only down almost 1.5. Almost 4, and then S&P dropped like crazy. You see here, DIVO does pretty well. All right, yield deconstruction, right? So this chart reveals how much of the distribution comes from organic dividends, right? If you don't know this, DIVO is not a traditional cover call ETF, so DIVO does act more like a regular ETF with a cover call spin to it. So that's what makes DIVO a nice rock core position if you are new. Not financial advice, but I do love DIVO. Versus other sources, options, premiums, and return on capital. For high yield funds, dividends are a tiny fraction of the payout. So we got to look at DIVO. Let's just X this out, right? So DIVO, the yield is 1.66. The actual annualized yield is about 5%. So it is a little misleading right now, but this is just a chart to visualize right here. not from dividends. ROC 3.2, as it holds out pretty well, right? So it's just the total distribution rate. As you see, DIVO aims for 5%. IDVO is about, it aims for, I think they aim for what, 8%, 10%. QDVO aims for, I think, 8 to 12%. And then you have baggy here that's crazy. So it's just what you prefer. And then we use I always use a hypothetical market just for visualization, right? This illustrates the core trade-off. The strategy provides a cushion in a down market and wins in a flat market, but always lags in a strong bull market. See here, bull market is cover call ETFs is it won't always do well, and then sideways market cover call ETFs absolutely dominates. In a sharp bear market, we have a cushion because of option premiums. Okay, part 5, the ugly tax trap, right? We always gotta remember that not everything is always going to be a return of capital until the end of the year, right? The most critical and ugly part of high yield ETF universe is the massive portion of the yield is not at all income. It's return of capital, which is simply the fund returning in investors' own principal back to them. Right, let's break it down here, right? As 19A note is shown, many of what is being distributed or 80 to 100% return of ROC. This is not yield, right? So QDVO is estimated to be 100%, but we won't know. And of course, DIVO, because it's not a traditional cover call ETF, it does kind of like a good decent amount of options premiums. And anyways, the ROC trap explained. ROC is a tax deferred, not tax free, right? So let's not get that mixed up. It reduces the cost basis by creating a tax bomb when the investment is eventually sold. Okay, so one, you the investor buy one share of SLJY for $20. The cost basis is $20. Yield, the good, the investor receives a $4 a distribution at 20% yield. They pay zero tax in the current year. The trap, right? The bad, the 4% ROC reduces the investor's cost basis. The new cost basis becomes 16, right? From $20 minus 4. And then the tax bomb, the ugly. The investors sell the share for $20, no change in value. They now owe capital gains on a $4 phantom gain. Okay, part 6, coming to my conclusion, the final verdict, right? And which portfolio fits you the best, right? These funds are not one size fits all. They are specialized tools, right? The beautiful CWT strategy is ideal for total return, while the ugly ROC-driven thematic funds are speculative tactical tools, right? Due to tax inefficiency, all are best held in a tax advantage account, because you will never know. Well, of course, that is ideal, but you can also hold it in a brokerage account because it could also be 100% ROC. We are income investors, so we don't want to be holding it in a tax advantage account. But for those who have tax advantage account, okay, these would be the best for you, right? What is suitable for you? For the core hybrid income total return recommended, I would recommend, if it was me, DIVO and IDVO. All right, these are the best in-class fund designed for total return with real upside participation and proven risk management, right? This is a nice, beautiful strategy. The only key warning I would have is that it has high fees versus something like a ETF like JEPI, and it has a non-diversified risk. For the growth-oriented yield kicker is recommended with QDVO, and yes, this is the ETF that I own. I used to own DIVO, but I switched it over to QDVO. It is I have to check, maybe roughly almost $180,000 in QDVO. I truly believe in the Amplified CW group. I love what they did with DIVO DIVO when I owned them. So I just kicked it out to QDVO for the growth portion of my portfolio, and we'll see. I mean, I hope they've picked the right tech stock, because it could, like I said, the risk was Nvidia crashing, and I could crash and burn with it. But it will be my long-term hold, so I'm not too worried, right? The key warnings that it has extreme concentration with 10% plus in the Nvidia, and the hidden risk of writing uncovered called index calls, right? For the max income tactical satellite would be your TLTP, Baggy, and EHY, right? I don't think they should be core holdings. They're extremely high risk to monetize volatility. An investor might use these if they are bearish or neutral and want pure income, sacrificing all the upside. All right, and the key warning to that is that it's purely synthetic, carries counterparty risk, and will dramatically underperform in a bull market. All right, and if you're a speculator, right, then you would go for SLJY, Solana, Biddy, and ETTY. Right, these would be more of the new guys on the block. Right, these are the new hybrid model, and an investor might use these funds if they're bullish on the miners and cryptos, and want to monetize that volatility while still capturing some upside, right? So the key warning here is extremely volatile, it's synthetic, it has the counterparty risk, and it's extremely high fees, right? These are speculative, not stable income, so they shouldn't be a huge part of your portfolio if you still want to own them. And then last but not least, these are the sources used to make my presentation. I hope you guys liked it. Again, I used to own DIVO, and now I switched it over to QDVO. So I do love the Amplify Fund. I do love CWP and how they operate, how they execute. I love their strategy. It aligns with me, since I want to buy and hold and grow with it, and eventually, hopefully, pass down a my portfolio. So I hope you guys liked the video. I hope you found it informational. And again, let me know if you own anything from here. Let me know how it's been treating you. Let me know if you know what, I have it, but after seeing this video, I'm gonna sell out. Or you know what, I was thinking about it. It was a watch list, but after watching this video, I'm gonna buy some. Please let me know. Fact check me if anything. And again, not financial advice. And stay tuned for the next. Thank you for following me on my journey.